Welcome back to Strongman Personal Finance. Amazon stock is now up 3%, bro. What's going on here? Well, Amazon just released earnings, and we're going to go through them right freaking now. So, Amazon has just announced their third quarter results ended September 30th, 2023. That's as of about 30 days ago. Net sales have increased by 13%. That's right, this massive giant company has increased their sales by 13%, outstripping inflation. Their North America segment increased revenue by 11%. International, bro, it's trash, increased their revenue by 16%. And AWS, which is AI Cloud, increased their revenue by 12%. So overall, pretty impressive growth in all three of their main segments. However, I thought, AWS was the big daddy and it was going to grow super fast. I mean, 12% is impressive, but it's, the second slowest growing. Operating income. They've also massively increased their operating profits. Operating profits are your profits before interest and taxes. So their operating segment income for North America recorded $4.3 billion of profits compared to $0.4 billion of losses in the third quarter of 2022. That's a huge swing. International, it's trash, bro, still is losing money, but I think that's going to flip at some point, okay? And they lost a lot less money, $0.1 billion as opposed to $2.5 billion. So Amazon, you can see they're massively swinging from losing money, basically being carried by AWS, and now they're making freaking bank, okay? AWS, operating income of $7 billion. So basically the vast majority of their operating income, let's do the exact math here. $7 billion divided by 11.2. 63% of their operating income, their operating profit, comes from AWS. That's why everybody watches AWS. It's kind of a big deal for Amazon. Net income increased to $9.9 billion, or $0.94 per diluted share, compared to $2.9 billion. Huge swing in profitability. Obviously, we know it mostly came from their North America segment. But AWS is also massively improving. I mean, basically everything's improving, okay? Free cash flow improved to an inflow of $21 billion of free cash flow, okay? Look at the swing. From $21 billion positive to 19, or basically negative $20 billion in the trailing 12 months ended September 30th. Pretty freaking good, okay? So, they talk about a bunch of highlights here. The one thing I love about Amazon is the Wheel of Time, okay? I've read all 16 of these books, or 16, 18? It's a lot of freaking books. It took me like 5 years to read them all. I started reading them when I was deployed. Great books, and the show is awesome. I love the show, okay? So I'm bullish on Amazon because of the Wheel of Time. That's the only reason. I'm kind of like, I like the show. Now, let's go ahead and dive into the financials a little bit more. This is all fluffery at the end of the day. I like to look at the numbers, baby. So next, we have fourth quarter guidance. This is the holiday season. Net sales are expected to be between $160 billion and $167 billion, or to grow between 7 to 12%. That's pretty broad, compared with fourth quarter of 2022. This guidance anticipates favorable impact of 40 basis points from forward exchange rates. Operating income is expected to be between $7 billion to $11 billion, compared to $2.7 billion. Huge swing in profitability. Can't hate it, baby. Everything's looking good. It's large cap tech, bro. So here is the statement of cash flow. So we have a comparative statement of cash flows for the 3 months ended September 30th, the 9 months, and the 12 months. Now, when you look at it, the statement of cash flows is three main segments. You have operating activities, cash flows from operating activities. This is from the core business. You have investing activities, which is, buying property, plant, equipment, buying investments, selling investments. And then you have financing activities, which is how the business raises cash, or a dividend if they paid one. That's where a dividend would show up, would be in financing activities. But those are the three main segments. So we could see some pretty incredible improvements. So for the 3 months ended September 30th, 2022, they produced $11 billion of positive operating cash flow. They doubled it. Year over year, they freaking doubled it. On top of that, they reduced their spending on property, plant, and equipment. Last year, they spent $16 billion in 3 months. This year, they only spent $12 billion. So you can see the swing in free cash flow. It was negative here. Now it's positive because they're not spending as much and they've increased their operating cash flow. For the 9 months, they still have positive free cash flow, $42 billion of operating cash flow on 38 of capital expenditures, compared to the prior year where they were just investing like freaking crazy. I mean, like, that's a lot of money they were investing compared to their cash from operations. And then for the 12 months, they also have positive free cash flow. So huge swing in profitability. Let's see what they did. So we know they purchased less of property, plant, equipment. They sold a little bit of equipment, but nothing crazy. Acquisitions, they doubled their spending on acquisitions compared to quarter over quarter. Sold some marketable securities, nothing crazy about that. I don't see any problems. Let's look at financing. So they issued some debt, and then they paid a bunch of short-term debt, and they made payments on their finance leases. They basically just paid off a lot of debt. Okay, I don't see any major inflows of cash. They borrowed a bunch last year for the 3 months, $12 billion. Now they're just basically paying off debt. So positive free cash flow, paying off debt, huge, strong margins. I don't see an issue here. The question is, how much do you pay for the stock? We can see revenue. So we got net. This is 3 months into September 30th. Product sales are up a decent amount. Service sales are up way more. And they actually have disaggregated revenue further down, which we'll see in a second. Obviously, cost of sales are up. Fulfillment's up a little bit, but nothing crazy. Technology and infrastructure is up a little bit. Sales and marketing is down year over year. They cut some sales and marketing, and they cut some general and admin. With all those cuts and the increase in revenue, they increased their total, or they decreased their, they increased their operating expenses, but not as fast as they increased their revenue, which is what you want. That's why they had $11 billion of operating income in 3 months. It's a lot of money, okay? They got some interest income, nothing crazy. They have a little bit of interest expense. It basically washes itself out. And then they have other income and expense. I don't know what that is. We'd have to find that somewhere else. But overall, they're doing pretty good, okay? We see some share issuance. Obviously they're issuing shares, but it's not like insane, crazy, mind-blowing dilution. There's a little bit of dilution, but nothing crazy there. Okay, let's go down and let's see some more segment information. So this just breaks down the profit and loss, the net sales and the operating expenses by segment. So you have North America, Amazon, Whole Foods, International, then you have AWS, Amazon Web Services or whatever. Now we can obviously see that basically all the profits come from North America, which had a huge swing, and a lot of profits come from AWS as well, but the increase in profit was not as dramatic as it was for the North America segment. I mean, huge change. And while international is still unprofitable, that's basically profitable. Negative $95 million operating loss on international. On that increase in sales, they're doing pretty good, okay? This will probably become profitable at some point. I'm sure currency is impacting that, but I have no doubts that will become profitable, okay? So overall, let's see, year-over-year sales growth. We already covered this. AWS, it didn't grow like insanely, like 30%, but still pretty good, with international really having the highest sales growth. The vast majority of their sales still come from the North America segment, with international taking second place, and then AWS at 16% of total sales. Balance sheet, let's see, no changes really in cash, inventories. I don't really see any crazy changes. We see they bought some property, plant, equipment. They signed some more leases. I don't see anything crazy. Goodwill went up. They did some acquisitions. Nothing crazy. Long-term debt got paid down. It's pretty good. Pretty good. Treasury stock. So it looks like they did not buy back any stock. You can see the numbers haven't changed. This is where you would see stock buybacks. They didn't buy back any treasury stock. But they did have an increase in additional paid-in capital, which is probably from, what the hell is this? That's probably from stock options. When you don't see the shares increase, but you see additional paid-in capital go up, it's probably from stock options or something like that. Accumulated other comprehensive loss, that's just a few special things that pass the income statement. And obviously retained earnings has gone up, which means the difference between these two is basically the profit that they recorded over the period. Overall, what's to hate? What's to hate, boys? Let's see. There was another thing right here I wanted to look at. They disaggregated it by specific items. So this is a good one right here. So they break it up in a little bit more detail where their revenue came from. So online stores, Amazon.com, grew revenue at 6%. Physical stores grew revenue by 6%. Third-party seller services revenue, 18%. Subscriptions, 13%. Advertising, which is very profitable, up 25%. I know, because my business is advertising on YouTube. And we know AWS was 12%, and they have other 3%, which I don't know what that is. Overall, But what's the hate, boys? They cut some employees. Great earnings. Amazon's doing just fine. I'm glad this is in my portfolio in VT. I'm not going to overweight it because, efficient markets and all that. But overall, pretty impressive earnings. I mean, I don't know if you love AWS and that's your end-all, be-all. Maybe the revenue growth wasn't that amazing to you. But basically, every one of their segments is profitable except international. But that's probably going to get profitable pretty soon, in my humble opinion. But we'll see. So overall, that's Amazon's earnings. We'll see what the stock does. It'll probably vertical line because it's Amazon and they got the wheel of time. So it's good stock. And I'll talk to you guys later. Cheers!